I mean, FTSE is probably the only big index in the world which doesn't have any single tech stock, right? Mm-hmm. And it was all about tech in May. So I think one of the reasons why the index has done so badly is the lack of tech. And investors are just looking for tech at the moment. That's why Nasdaq is doing so well. So that was one thing. And then on the other hand, as you rightly said, Joanna, you have this issue about China back now. Yeah. People are worried about Chinese growth, and we've seen obviously an unwind of this reopening trend, which has been hurting commodities in particular.
Yeah, but to pick you up on that point, it's surprising to me that the DAX actually still managed to sort of eke out relatively a better performance than some of the other indices, because Germany is a lot more exposed to China. So what do you point that back to?
I mean, again, Germany has been helped by tech. You have more tech stocks in the DAX. So I think a lot of the market dislocation or dispersion we've seen this month was largely explained by the tech, composition or influence on the different indices.
Do you expect that dispersion to continue, that leadership in tech, which has been really extraordinary, especially in the U.S.?
Well, it looks a bit frothy, I have to say, but we just published a report this morning showing that tech is not crowded, tech is not overowned. At the start of the year, most investors were kind of underweight tech because for most of last year, because of higher interest rate, investors are unwinding their long duration trade. So they did start the year with a very low exposure to the sector, and now there's a bit of fear of missing out, pushing investors to chase. So again, it's never healthy to see such a very narrow leadership in the market, but our sense that there might be a bit more of this chasing, pushing up the tech-heavy indices.
Wow. Okay, so potentially some further ground to cover. Let me just come back to China. The data out of China has been fairly downbeat recently, softer than expected, last night being no exception with the new factory activity data coming through. To what extent is that weakness already priced into European equity markets, or is there more downside risk to come?
I think the market was maybe not fully buying this reopening in the first place. I mean, you've seen things like mining, for example, doing badly for pretty much most of the year. While on the other hand, luxury, consumer exposure did extremely well, right? So I think the market was very much focused on the consumer side of reopening, which has now been hurt, and we are seeing the unwind of this trade. What I think is surprising, and no one seems to be keen on positioning for some kind of stimulus. I do find the market quite downbeat on the prospect for more pro-growth policy in China. And, in some respect, if you think about some of the stocks, again, in the commodity space, energy, materials, miners, chemicals, they look quite depressed now. And we do think that China will come with some kind of policy support in the second half. Maybe no bazooka, no extreme, no aggressive policy, but enough in order to put a floor under the space.